Hello and welcome to the Monday Futures Market Outlook for October 3rd, 2011. This is Patrick Ceresna. For those of you that have not had the opportunity to try out eminisource.com's trading room, 5-day complimentary memberships are available on the website. As always, we start off with a weekly chart of the S&P 500 going back 3 decades, and we plot an 80-week moving average on there. It does a very good job to depict the bull and bear market cycles that the market has gone through. A couple months ago, we bearishly crossed below that 80-week moving average, potentially suggesting that we are in a new bear market. Just to make some key intermarket observations, the landscape of the markets has dynamically changed over the last 2 months. And now that we're trading below that 80-week moving average, it has signaled the potential beginning of a prolonged bear market. And to accompany that, we've now seen a very strong US dollar that has broken out of its trade range, particularly against the euro, but now has been confirmed by a number of different currencies, a significant breakdown in the Canadian dollar, the Aussie, the British pound has significantly broken down, and even the Swiss. This strong US dollar and weakening global currencies will continue to damper the commodity markets as we've seen them continue to weaken. In addition, the 30-year Treasury bond continues to rally higher. Now we've hit actually some of the upside targets that we've set out on the last couple of weeks, so we do anticipate there being only limited further upside on those 30-year Treasury bonds, but it does not necessarily make them a shorting opportunity yet. When we take a look at the S&P 500 on the daily charts, we've been talking about this flagging formation reversing off that 1200 to 1250 area and a potential breakdown on the downside. We're definitely seeing that occurring here, and really at this stage we're going to be watching for significant support first at the double bottom retest around that 1100 area. But if the S&P makes that break, we should have a pretty quick drop down to about the 1170 area on the downside, and we potentially could see lows even in the 1050 to even as low as 950 areas on the downside. But before we get overly bearish this market, we're going to first look to see whether the market can actually hold the 1100 area, where all those key double bottom tests will occur. But if we do see any selling that is breaking through that 1100 area with any momentum, you have to anticipate that there's a minimum even 50 to 100 S&P points downside risk. Next year, I'm going to take a look at the US dollar index, and one can see that continued strength in the US dollar. We continue to anticipate that the dollar can strengthen as the euro probably heads down to the 132 to 130 area on the downside, as well as the Canadian dollar and other currencies like that still have a couple cents to go before their moves are finished. So the dollar index could easily make it up to this 80-81 area on the upside. If there's a very strong capitulation within currencies, then we could see even a retest of the highs of the dollar from January, where we could see the 82 to 83 area. But initially, we're just going to be looking for about another 1 full point higher on the dollar index. Next year, when we take a look at copper futures have already hit our key support line down below. We only think that there's limited downside risk of copper here before we get a flag backwards. No way do I believe that this necessarily means that we've seen the bottom and a major buying opportunity in copper, but the downside move on the downside of copper here is probably going to end here within probably the next 20 to 30 cents if it hasn't already put in some sort of a short-term low. At that stage, we're probably going to see some sort of a Fibonacci style retracement back to 340, 350 on the upside before maybe the tail end of the year we see another potential sell-off in copper. But we do believe that this move downwards is pretty mature. So anybody that has been short copper for an extended period of time, this is a very good time to lock in profits, or at least build in hedges to lock in your existing prices on copper. Next year, I want to take a look at gold futures, and the drop in gold was very rapid and sharp. We were looking for the tops of gold to come in, but we're not necessarily looking for an outright crash in gold, but we definitely got one. It's now consolidated down to where the key consolidation lows were back in May, June, and July. Really, at this stage, this is a level where we probably will see the bottoms of gold temporarily, especially especially if the currency stabilize at these lower levels. If that's the case, then we probably are going to be defining the bottom end of a range on gold. Now, the top end of the range of gold will not be 1900 anymore. It's very unlikely that we're going to see 1900 for at least the remainder of this year, and more than likely the 1700 to maybe 1750 area should cap most rally attempts in gold. So there definitely, if we find a short-term bottom here on gold, there's definitely $100 an ounce room on the upside before overhead resistance starts kicking in. Next year, I want to take a look at crude oil. And crude oil, we've been identifying this flagging formation and patiently awaiting a breakdown move on crude oil. We still think that there's room for crude oil to make it all the way down to $70, and if there's lots of momentum, even $65 on the downside. But it really has taken a long time for this breakdown move to occur. Really, at this stage, we continue to believe it's a likely course of action, but into any breakdown moves here, it would be prudent to be locking in some profits into aggressive selling, as we probably into this wave of selling will see the intermediate low on crude oil before we see some retracing or consolidation patterns. Finally, I want to take a look at that 30-year Treasury bond, and we saw that break of that 40-42, sorry, 140-142 area on the upside. We measured out moves as high as 145 to 152 on the upside, giving a pretty big range. We hit right into that zone and reversed. Now, Treasury bonds will probably make another attempt at these zones again, and overall, probably up here, we will see some sort of key highs up in the 30. Probably the high of the year in that 30-year Treasury bond. It doesn't necessarily mean it's going to be a major shorting opportunity, but because the next time the 30-year Treasury bonds will sell will be when there looks like there's going to be an economic recovery. So that probably may still be many months away. So we probably are finding upper end range levels of the 30-year Treasury bond where we should spend an extended period of time, maybe numerous months, before there's a really good topping formation and subsequent reversal in that 30-year Treasury bond. That was your Monday Futures Market Outlook. Thank you for joining me.